Welcome to This Explainer. I am so thrilled to have you here today. Look, everywhere you turn online right now, financial advice seems to echo the exact same sentiment, right? Just buy index funds, hold them forever, and you're going to be golden. And honestly, it's mostly fantastic advice. But as with pretty much anything in finance, there are crucial details that often get left out of all the cheerleading. And a few of those omitted details can quietly cost you a fortune. So today, we're going to pull back the curtain and reveal the uncomfortable truths of index fund investing, so you have the complete picture before you invest rather than after you've made a costly mistake. Let's get into it. Here's our roadmap for today. 1. Why index funds win. 2. The diversification illusion. 3. The emotional investor penalty. 4. The set and forget trap. 5. Not all funds are equal. And 6. The ultimate investing truth.
All right, let's jump straight into Section 1, Why Index Funds Win.
Let's take a look at the S&P 500, which tracks the 500 largest public companies in the U.S. Since it launched way back in 1957, it's returned roughly 10% a year on average. Now, yes, that's before inflation, but it is still a remarkably strong and consistent track record over decades. It completely validates the baseline strength of this simple investment.
And this right here brilliantly illustrates why everyday investors just flock to it. Over the last 15 years, roughly 90% of professional managers overseeing U.S. large-cap funds actually underperformed the S&P 500. I mean, really think about that for a second. We're talking full-time professionals with massive research teams, proprietary data, decades of experience, and 9 out of 10 of them couldn't beat a simple passive index. When you layer in the high fees those pros charge, the index fund's dominance becomes absolute.
Which brings us to Section 2, the diversification illusion.
People generally assume that owning a 500-company index means their money is spread evenly. Like you put in $1 and it gets chopped into 500 equal little pieces, right? Well, that's an illusion. In reality, the index is market cap weighted. What this means is the biggest companies get the biggest piece of every single dollar you invest. You aren't actually placing 500 equal bets. Your portfolio is heavily tilted toward the absolute giants of the market. And the reality of that tilt is pretty dramatic. Nearly 40% of your entire investment is concentrated in just 10 mega-cap tech names. We're talking companies like Apple, Microsoft, Nvidia, Amazon. That leaves the remaining 490 companies basically fighting over the scraps. The bottom 250 companies in the index barely move the needle for your portfolio at all. If those top 10 have a bad year, your supposedly safe, diversified fund is going to feel it hard. Plus, keep in mind that an S&P 500 fund is entirely composed of U.S. large-cap stocks. It completely leaves out massive, crucial asset classes. You've got zero international exposure, zero small caps, no emerging markets, no bonds, no real estate, nothing. To get true diversification, you really need to consider adding total market or international funds to plug those massive gaps.
Moving on to Section 3, the emotional investor penalty.
Okay, so index funds boast these incredible long-term returns, but those returns only go to the people who actually stay invested. And historically speaking, staying invested is terrifying. Just look at the history: the dot-com bust, the 2008 financial crash, the sudden pandemic plunge in March 2020. During all of these moments, the index dropped 30, 40, even 50%. These moments intensely test the emotional discipline of everyday investors.
And sadly, a lot of people fail that test. Check out this astonishing fact from a 2024 Morningstar report. Over the previous 10 years, average fund investors actually earned 1.1 percentage points less per year than the very funds they owned. Now, you might be wondering, how on earth is that possible? Well, because they panicked. They looked at their bleeding portfolios, sold at the absolute bottom just to stop the pain, locked in their losses, and then completely missed the inevitable recovery.
So the crucial takeaway here is this: the fund did fine. The humans got in their own way. An index fund does not come with emotional armor. Ultimately, your investment strategy is only as good as your ability to sit on your hands and stick to it without flinching when the screen is bleeding red.
Let's dive into Section 4, the set and forget trap. The absolute simplest example of this trap comes down to taxes. The exact same index fund behaves entirely differently depending on where it actually lives. If you put it in a taxable brokerage account, you're going to be subject to yearly taxes on dividends, and that's going to quietly shrink your after-tax returns without you even noticing it happening. But put that same fund in a tax-advantaged account like a Roth IRA or a 401k, and you get optimized growth. Putting the wrong assets in the wrong accounts is honestly a silent wealth killer.
But, it goes way beyond just taxes. Think about it.
An index fund knows absolutely nothing about your high-interest credit card debt, your need for life insurance, your estate plan, or what you actually want your life to look like in 10 years. A lot of people just buy an index fund, mentally check the investing box, and then they stop planning altogether. But if you stop at the fund, you leave your overall financial plan dangerously incomplete. It's essentially like buying a high-end sports car without a steering wheel. You've got a fantastic engine, sure, but absolutely no way to steer it toward your actual life goals.
Next up, Section 5. Not all funds are equal. So funds differ dramatically in what they actually charge you. And because expense ratios are taken straight out of your returns automatically, you never sit down and write a check. It's totally invisible. Now, a 0.015% fee, that has a pretty minimal impact. But a 1% fee? Over decades of compound interest, that 1% is a silent killer. It will literally drain hundreds of thousands of dollars from your potential wealth.
And you have to watch out, because Wall Street absolutely loves to create these high-cost, high-risk, exotic funds, maybe like a leveraged single-country fund, and then slap the label index fund on it to trick you. So the crucial point here is strictly following these 4 rules. Stick to broad market funds, use established and reliable providers, keep your expense ratios strictly under 0.1%, and please, for goodness sake, actually read the prospectus to see what the fund tracks before you put your hard-earned money into it.
All right, that brings us to Section 6, the ultimate investing truth. Now, before I reveal that ultimate truth, I want to quickly offer a solution for anybody who might be feeling a little overwhelmed by managing all this diversification and asset location stuff. A target date retirement fund is a brilliant, simple alternative. You literally just pick the year you want to retire, and the fund automatically handles all the details. It rebalances your stock and bond mix to become safer as you get older. It is easily the closest thing to true set and forget out there.
But here it is, the ultimate reframing truth. This is the line that should stick with you long after this explainer is over. How much you put in matters more than your rate of return. Look, you can obsess over finding the perfect index fund, optimizing every single tax loophole, and perfectly timing the market. But it means absolutely nothing if your foundational savings rate is just too low. The single biggest lever you have to build wealth is simply putting more money into the machine.
So let's do a quick recap. Index funds are a fantastic tool, perhaps the greatest tool everyday investors have ever been handed. But they are just a tool. As we've seen, you're a lot less diversified than you probably think. They offer zero emotional protection during market crashes. They definitely require broader financial planning, and the fees and structures out there vary wildly. You have to use them with your eyes completely open.
Which brings us right back around to the most important question of all. Are you saving enough? Because all the optimization in the world is not going to save a bad savings rate. I want you to think deeply about that question today. Thank you so much for spending your time and focus with me on this explainer. Keep learning, keep saving, and I will see you in the next one.